Welcome back to the Williams Real Estate Channel. Today we are discussing the property market update for September 2025. To kick it off, out of totality, we saw 0.8% uplift for the whole Australian property market for the month, 0.8% up. This consisted of 0.7 for the combined regions and 0.9 for the combined capitals. The leading markets for the month was Darwin with 1.7% and Perth 1.6%, followed by regional WA 0.3%, then Brisbane 0.2%, followed by Adelaide 0.9 and regional Queensland 0.9, regional Tasmania and Sydney at 0.8, Canberra 0.7, South Australia, regional South Australia 0.6, Melbourne 0.5, regional New South Wales 0.4, regional Victoria 0.3, and Hobart 0.1 for the month. So that's the monthly indicators. If we look now at the 12 months to date, we'll see that the leading market for the last 12 months has been Darwin, up 12.9% in the past 12 months, followed by regional WA at 11.6%, followed by regional South Australia at 10.4%, followed by regional Queensland at 9.3%. Then we saw Brisbane up 8.8% for the past 12 months, followed by Perth 7.5%, followed by Adelaide 6.2%, and then the rest of the markets ranging between 1.9 to 4.4%, being Sydney, Melbourne, Hobart, Canberra, regional New South Wales, regional Vic, and regional Tasmania. Pretty subdued markets for the past 12 months. So what I like to look at is the past 3 months and compare it to the past 12 months. So if in the past 3 months is up more than 2%, that's pretty strong. So if it's up 2% in the past 3 months and that is continued to materialize, that's about 8% for the year. The monthly indicators can be fluctuant, so more of a gauge to see where markets are heading is the past 3 months. So as we can see, solid growth out of regional WA with 3.7%. Again, they've got a solid past 12 months. And regional Queensland 2.7%. They have a reduced 12 months to 9.3, so not leading, but still pretty strong. And then we also have the likes of Darwin, 5.9% in the past 3 months. So that's very strong. And they are the leading market as of the past 12 months at 12.9%. Perth, 4, quite interesting to see that. Also the likes of Adelaide, 2.5%, pretty strong for the past 3 months, but again, losing steam, only up 6.2% for the past 12 months. And along with Brisbane, strong for the past 3 months, 3.5, and a solid 8.8% for the past 12 months. And then we have the rest of the markets being regional Tassie, regional South Australia, Vic, New South Wales, all sub 2% and even under 1%. And also the likes of Canberra, Hobart, Melbourne, and Sydney are low, except for Sydney. Sydney's starting to pick up at 2.1% for the past 3 months and 3% for the past 12. So potentially could be on a bit of a run here. Sydney could be starting in the years ahead, as indicated in the past 3 months. So that's where we're at as of to date. Also, I like to cut the data this way by looking at the median price points. So Sydney, number one. Historically, Sydney has always been number one, other than a couple of moments in history when the likes of Perth have taken the lead. But as of late, Sydney is number one median price point at 1.2 million, followed by Brisbane at just shy of a million in second place, followed by Canberra in third place with 885 grand median price point, followed by Adelaide in fourth place, and more or less Perth in fifth place with 855,000. Then we have Melbourne in sixth place still at 805,000. Then we have Hobart at 683,000 median price point, and Darwin coming in eighth place at 558,000. So Ken, explain the extraordinary growth coming out of Darwin as of late. It's coming off a low price point. We are also in the later stages of the land market where the likes of Darwin can start to kick off as what happened in history, where the mines and activity in those regions start to pick up now that we are in the later stages of the cycle. So that's where we're at as of late. And where are we heading into the future? Well, as you know, if you've been following us for some time, we use the 18-year land cycle as our framework to guide us through at a macro level of when to buy, when to even sell, when to add value, when to renovate, when to stop buying. So it is the framework we use. It's history, it's historical events, and we overlay it with historical sales data to work out where each market sits, as there's not one property market, there's multiple markets and sub-markets all the way down to a suburb level. So every suburb is running its own race across the whole country. So it's not a blanket rule. This framework is used to work out, firstly, where do we sit in the current market? Being on that blue marker, equivalent point of time would be late 2006, 12 months away from peak land market, give or take, 18 months to 2 years away from peak stock market. Come 2028, the market will turn into the next land-driven downturn. It will be like 2008 on steroids, or the 1991 recession we had to have, or 1972. You can keep tracing them back for over 200 years in the US, the UK, and Australia, and now more connected Western economies as we become more connected in trade. But this is our framework we use. And from that, we then peel back the layers to work out, okay, where each market sits as we look to invest in all these markets from Sydney, Melbourne, outperform the first quarter historically, then regional VIC, New South Wales, Tassie, outperform the second quarter, Brisbane, Perth, Adelaide outperform in the third quarter. And now that we are in the fourth quarter on that blue marker, we are seeing the likes of regional South Australia, WA, regional Queensland, and the likes of Darwin outperforming in the fourth and final quarter. So we are on this blue marker. Equivalent point of time is around 2006. So as we go through these future slides, look at where we are to date. And here we are to date for Adelaide, charging. But if we want to know where we could be heading for Adelaide in the future years ahead, we look at history. And if we look back at history and see what happened from 2006, there was a little bit more growth, but then it more or less leveled out and flattened out and went through this pretty well stagnant flat period for a good 10 plus years. So if you can visualize from 2025 and visualize from 2006 and onwards, that is more or less what could happen to Adelaide in the future years ahead. So not a market we're investing in as of late. Regional South Australia, similar story, booming as of late. But if you look back at history, from 2006-7 onwards, pretty much hit a top and pretty well went flatline and did next to no growth for a good 10 plus years. If we look at Perth, everyone's talking up Perth. Let's buy in Perth. What a great idea. Not. It's booming. Yes, it's booming. But look what happened from 2005-6, charged and then switched off and then went up and down within this band for many years. Perth, in my humble opinion, is becoming definitely more of a risk to the downside than future growth. Sure, there might be a couple more years of sugar hits to that market. That's when all the euphoria, speculation likes to charge in, all the FOMO, all the stupid money, as I like to call it, likes to pour into overheated, booming markets towards the tail end. But that's never a good time to enter a market because the risk is high for the downside. You'll overpay and you'll be holding an asset for many years with pretty average growth, and if not in negative equity, if you buy at peak market. So buyers beware. Regional WA. So this is down south of Perth towards the Margaret River Way. So this is charging. As you can see, massive boom recent years. Is starting to show signs of losing a bit of steam, but is still going pretty strong. And if we look back at history, look what happened. 2005-6, kept running and then switched off. And then from 2006, it went backwards for over 10 years. So I believe regional WA has maybe another 6-12 months to go, but once it does turn, it'll land in negative equity from where it's at today. So again, another market we're definitely not buying into because you are buying the future growth when you buy property. Most people look in the rearview mirror and buy into the hype. It's booming now. They think the party will go on forever, but the party never does. The lights come on. Everyone ends up going home with a hangover at some point. So don't get caught up in the fuss because the party definitely doesn't go on forever. So regional WA definitely is not a market we're looking at this stage of the cycle, as if you look back at history, it is in a critical point where it could go through this negative growth path, and you don't want to get caught holding the bag when the market turns, because you can imagine paying what, 700 plus thousand million bucks for a house in the regions, and then next minute market turns and it's worth 500-600 for over 10 years. So that's what you call mortgage prison, where if you bought a property, overpaid, paid a premium, market turns, you're in negative equity, the banks won't refinance it because you got no equity to refinance. You're locked with that bank. You can't move it. If you sell it, you'll sell it at a loss. And that's the danger zone, because if you can't rent it out, or if you get caught in a situation, if you lose your job or you lose your tenant and you've got no income and you're forced to sell, then that's the type of stuff that can wipe people out. Is the market cycle. The market can make or break you. So buyers beware of these types of markets, especially regional WA at this stage. Brisbane, await the races. As you can see, happy days, await the races. So we've got a number of properties around this in these suburbs up in Brisbane. And as you can see, I love doing this video every month. It gives me clarity, even personally, of what do I do with my own assets? Do I buy it? Do I sell it? Do I refinance it? What do I do? And I've got assets up here, and as you can see, it's still got a couple of years worth of growth until it's probably due to top in a couple of years, and then we'll soften a little bit. Brisbane's pretty good. It's not like Perth and heavily dependent on the mining sector. It's only an hour flight from Sydney. It's got more of a diverse economy. It's not just hooked to mining. So compared to Perth, it's similar size, but Perth can boom bust. Brisbane is a lot more resilient. So it won't go through that severe downturn, but we'll hit a top. And then, as you can see, what happened from 2007-8, went pretty much nowhere for a good 10 plus years. So again, a market we're not buying into. We were buying around 2018 to 23. I think the last one was early 24 for a client that wanted to get a quick lick. But we stopped heavily buying around 21, 22, because once it starts to pop, then there's other markets we can move on to get better deals. So we are looking now. I mean, personally, I'm looking to even sell out of Brisbane next year to shuffle funds around to reinvest into other markets and bigger assets to capitalize on future growth, because the upside in Brisbane probably got another 30, 40%, if that. And then at some point it will top, soften, and then flatline for many years. So something to contemplate, but don't get caught up in the fuss of the FOMO and the Olympic Games and all the bullshit. The Olympic Games was priced in 5 years ago. Everyone charging you now because of the Olympic Games, yeah, that's a fool's game. You need to get into the market 5, 6 years ago, because the Olympic Games is coming in 2032. But by then, the market will be smashed. Come 28, 9, 30, end of this decade, Brazil will top and feel the brunt of it. The Olympic Games, I don't believe, will have enough in it to prop it up and save it. The market is not as forgiving as it could be. So I don't think there's enough in the Olympic Games to really keep it going and push it to the next level. It'll give it a final euphoria now in the coming years, but a bigger boom means a bigger bust when the market does turn. So buyers beware. Brisbane is no longer a market we're currently buying in. We will come back in time, but at this stage, the ship has sailed. Same goes for regional Queensland. Now, regional Queensland, I know a lot of punters are out there charging into regional Queensland. Makes me laugh. It's unfortunate though. Every boom doesn't really matter what asset class it is. If it's property, stocks, shares, crypto, it all becomes mainstream towards the tail end of a boom, and everyone charges in with the FOMO. So once everyone is doing that, it's never a good idea to keep buying into those markets. Regional Queensland is similar to the likes of Perth and regional WA, where it has that dependency on the mining sector. So the risk now for the downside for regional Queensland is becoming higher and higher. As you can see, we are await the races. This is one town in regional Queensland, but if you run the historical sales data reports for all the towns, you'll see a very similar pattern and even a more severe boom bust pattern the more north you go. So buyers beware. Even if the yields are good today, if you look back at history, the yields were fantastic in 2006, 7, 8, 9. As the mines were booming, people had money. People, if you had got more money, you spend more money. So it ultimately filters down to the benefit of land price, pushes rents, pushes high prices as those rents get capitalized on higher prices. But when the mines switched off and those jobs dry up, people don't have the cash in those regions anymore. They can't pay the higher rent. The rents also soften. So the rent softens, that then counteracts the land price or the property prices, and then down it goes through a downturn. So similar to what happened from 2009 to 19, where this particular town, but very similar across all regional Queensland, lost over 30, 40% over 10 years, will happen in the future years ahead. And the boom now looks more aggressive than the prior boom in 2006, 7, 8. So the bigger the boom, the bigger the bust. So buyers beware. Regional Queensland is not a market we're buying in anymore. We were from around 19 to 2021, 22, 23 by the end of it. But again, I'll be offloading everything out of Queensland and regional Queensland because I'd rather sell out peak market, subdivide into two, push the development as much as I can, maximize the yield out of the site to sell them all off. So I bought half a dozen houses that can be subdivided into two, build second houses, and then sell them all off peak market in 3 or 4 years' time to raise cash, pay down debt, free up serviceability to invest into future markets ahead and protect the downside. Because who wants to hold an asset for 10 years and lose 40% growth? That's not fun. So definitely not a market we're acquiring in 2025 in regional Queensland. And it's even coming towards a point of time to start thinking about selling. Darwin. I mean, I'm not a super fan of Darwin. It's has been, I mean, going strong in recent years, but it's has picked up from 2019 and then looks to have hit a bit of a trough and stagnate a bit and starting to pick up again a little bit. It's not showing signs of this significant boom, what happened pre-GFC and throughout the GFC. History doesn't repeat exactly, but it rhymes. I don't believe Darwin is set to go through that significant boom. Plus, Darwin has other complications. So I believe there's better markets to invest than Darwin. Can be very volatile. Plus, it can be have challenges managing property in the likes of Darwin. So there's definitely better markets, more premium markets that you can invest in and still at the same price points to get better value. So that's Darwin. Hobart. I like Hobart. We'll eventually get down to Hobart, but not at this stage. As you can see, Hobart had a solid run off the back of Melbourne from around 2017 to 22, topped out, has since softened, started to stabilize, and is probably going to go through a similar growth path of what happened from 2006 to 15. Next to no growth. So there's plenty of time on Hobart. Same goes for regional Tassie. Similar story, had a solid boom recent years, but topped out in 22, softened, showing signs of stabilizing, but is set to go through a pretty well stagnant flat period for a good 10 years before experiencing another significant boom. So we'll keep tabs, we'll keep an eye on it, but at this stage, there's nothing to gain and nothing really to lose in Tasmania. Similar story, topped out around 22, had a solid boom off the back of Sydney. Historically, the regions outperform off the back of their respective metro, and then topped out in 22, softened. Is starting to pick up a little bit, but it looks like it'll continue along this band for a good 10 years before experiencing another growth run. So this is more central New South Wales. If you look at different towns, they run slightly differently. The framework of the 18-year land cycle doesn't know where a state starts and the state begins. It's more down to the region. So the likes of northern New South Wales runs more in a rhythm similar to southeast Queensland versus central and south New South Wales runs in a similar pattern to this. And the further south you go to regional Victoria, runs similar to this, where again, they've had a solid run recent years off the back of Melbourne, topped in 22, went through a bit of a downturn, starting to show signs of stability, has started to pick up recently. I think there's a lot of pent up demand currently from investors. A lot of investors are charging out there, buying up houses and building granny flats and trying to manufacture yield that way. That doesn't make sense to me. I would only buy into a market once the yields have become attractive, 6, 7, 8%, not when they're sub 5. Because if you're buying an asset with a yield of less than 5%, you're overpaying for that property relative to the earnings. So it's got time. And similar to what happened in 2005-6, came up a little bit, but then died in the arse. And then started to trend up. So there is a bit of time on regional VIC. So for houses, not probably the go, but if you're looking to buy, say, a set and forget asset like a block of units and put it in your super fund, or if the deal makes sense and you can get the yield based off the price that you're paying, then it can make sense. And if you're not reliant on refinancing that asset within the near term, 5, 6 years, then sure, you can buy in regional VIC at this stage. I mean, personally, I bought a block of units in regional Victoria last year for 665 grand, block of 4, 1 bedrooms, turnkey, renting out for about 60 grand a year now. So good 10% return. The value on that, I mean, I could sell that easily for a 6% yield. So it's $1 million asset. So they're out there, they do arise, they do come up. So blocks of units at this stage for regional VIC, but in terms of houses to get immediate growth, there's better markets to invest in, such as Sydney, where the growth is on the horizon and will kick up a lot more aggressively than the likes of regional Victoria in the near term. As you can see, Sydney units have been through this stagnant range for the last 10 years. And if we look back at history from 2005, 6, 7, continued to do so. But then come 2008, she took off. So Sydney is primed for the future years ahead, along with Melbourne. So Melbourne has already started. I feel Melbourne bottoms middle late 2024 and is only up from here. So Melbourne's good, definitely good to get in to get an uplift. Not every asset class though, so not everything will outperform. You want to be buying particular types of properties. It's not a blanket rule that everything will run. Ultimately, a rising tide will lift all ships, but to get the outperformers, there's only a certain type of property and price point and yield that will get the significant growth. But Melbourne is coming off a very low base, sixth medium price point. Historically, it's second behind Sydney. So Melbourne's good. I mean, it's got the negative sentiment around the tax, land tax, but if you run the numbers, you'll find that the holding cost in Brisbane, Queensland, is 3 or 4 times more from rates, insurance, owners corp, strata fees than of Melbourne. So yes, you're paying land tax in Melbourne, but the rates are a quarter of the cost. The owners corp are half the cost. The insurance is a quarter of the cost. You got to remember, regional Queensland, Brisbane have been hammered recently with the floods, hurricanes. So they are also trying to claw back the cost of cleaning up the streets, also the insurance claims, and the future investment going into Queensland for the Olympic Games. Getting ready for such event is a costly exercise. So ultimately, the local councils raise cash through the rates, and you'll find that the rates up there, 4.5 grand a year. Rates in Melbourne are 1,200, $1,000, 1,200. Sure, you got to pay some land tax, but it's cheaper in Melbourne than in Brisbane. So it's all the media hype train around Melbourne. But once the mainstream herd finally catches on, it'll be flooding in and we'll be on to the next market by then. And this is where I feel the markets are sitting based off 2025, where we are based off the 18-year land cycle framework and running hundreds and hundreds of reports of historical sales data reports. I run the report of every property I look at to a suburb level. But at a macro level, This is where I feel each market sits. We have the likes of Adelaide showing signs of top and will top out within the next 6-12 months. Same goes for regional South Australia. Probably got another year or so to go and then it'll top out. Perth, WA, within 2 years will top and start a downturn. Brisbane, regional Queensland, Darwin have probably another 2.5, 3, maybe 4 years to run. So about three years before it will then top and then go through its downturn. And we have the likes of regional Tassie, Hobart, New South Wales, all topped out around 22, and Victoria topped out around 22, have gone through their downturn, are showing signs of stabilizing. The likes of regional Victoria is stabilized and starting to stagnate, will continue to stagnate. So it is starting to enter a market where we're looking at, but the best markets to buy in 2025 are Melbourne and Sydney for the future years ahead. And then if you get into those markets, you'll be able to get great equity uplift within the near term to then refinance, draw the equity, and then whack it into the likes of regional Vic, New South Wales, and on she goes, onwards and upwards. If you're keen to invest, buy an investment property, if you want help, shoot us an email. We can jump on a call, discuss where you're at, discuss where you want to go, and how we could help you build a long-term sustainable portfolio using the knowledge of this, plus also other facets of fundamentals that I like to use, including the price point relative to the build costs, having a high yield in a suburb that will gentrify, in an area that's getting growth from population growth and investment from both the public and private sectors, to ultimately buy in the suburbs that will flourish over time with the overall layout and guidance of the 18-year land cycle. You will never do wrong. As always, this is by no means financial or general advice. This is general content in nature. This is my thoughts, my story. This is how I invest. This is how I get my own clarity of where to buy, where to sell, where to refinance, where to keep, what to keep long term, what to sell. There's always, building a portfolio is a long term and a short term play. I've got properties that I look to buy and sell within a 7 to 8 year window. And then I've got properties that I look to hold for long term, 20 plus years. So it's always a moving target. You always need to move money around if you're looking to scale a large portfolio. And this framework will give you that guidance of when to buy, when to sell, when to refinance, when to develop, and when to stop buying. Is by far the key. Is don't get caught up with the fuss. Don't get caught up with the FOMO. There's always plenty of time to buy property, and it's not in the market that you may think is the mainstream herd are talking about. It's not the talk of the town types of markets. So if you want help doing much of the same, get in touch today. Until next time, thanks for watching.